This trend-following forex trading strategy uses multiple time frame analysis to identify and confirm the direction of the prevalent trend for any currency pair within the foreign exchange markets. It also capitalizes on multiple time frame analysis to find super low risk, high probability trade entry and exit points on the lower time frame charts of whichever forex currency pair you decide to use it to trade with. In the first step of this trend-following forex trading strategy's low-risk, high-probability trade setup identification process, you're going to learn how to determine forex trend direction for any currency pair you wish to analyze within the global spot forex markets. Now, in order to successfully accomplish this task, we're going to be using the daily time frame of whichever currency pair we wish to trade within the spot forex markets. Whenever price successfully crosses and closes above the 360 period simple moving averages on the daily time frame of any currency pair, we're going to conclude that the overall direction of the trend on that currency pair is a bullish trend according to this strategy's rules. On the flip side, if price crosses and closes below the 360 period SMAs on the daily time frame of the currency pair we wish to trade, we're going to arrive at the conclusion that the direction of the trend on that particular currency pair is bearish, just like the examples which you're seeing on my screen right now. And that almost brings us to the end of the first step in this forex trading strategy's low risk, high probability forex trade setup identification process. The reason why I say almost is simply because there's one more thing which we'll need to do before we'll be allowed to move on to confirming the direction of the market's prevailing trend according to the time-tested rules of this proven trend-following forex trading strategy, before finally moving on to finding trade entry and exit levels in the direction of that trend which we could fully take advantage of. And that thing is learning how to filter low-risk, high-probability forex trade setups from high-risk, low-probability forex trading setups using the Average Directional Movement Index indicator, which is also commonly referred to as the ADX. Doing this is going to help us to stay away from taking low-probability trading positions during ranging and weak trending market conditions. You see, whenever there's a strong trend within the markets, the Average Directional Movement Indicator is going to show that to us by crossing above the horizontal line which we placed at the 25 level reading of the indicator during our chart setup process just a while ago. And since we are only looking for low risk, high probability trade entry and exit points during strong trending market conditions, we're going to completely ignore all of the trend signals on the daily time frame of the currency pair we wish to trade if the reading on the Average Directional Movement Index indicator is below the horizontal line which we placed at the 25 level mark of the indicator's window. In the example which is being displayed on the screen now, you can see that the blue line of the ADX indicator has clearly crossed and closed above the horizontal line which was placed at its 25 level mark, signaling to us that there's a strong trend in the markets. And when you look at the price action on the chart above the ADX indicator in this example, you will notice that price also crossed and closed below the 360 period simple moving averages on the daily time frame of this currency pair when the blue line of the ADX indicator crossed above the horizontal line which was placed at the indicator's 25 level mark. This is simply telling us that there's a strong bearish trend in the market. Therefore, according to the rules of this trend-following forex trading strategy, we're now allowed to move on to the second step of its low-risk, high-probability trade setup identification process, which is confirming the direction of the market's prevalent trend.